Welcome to the first episode of the Wealth Blueprint. Today, my business partner and friend, Nathan Howery, joined me on this episode. Nate is my partner in Mortgage Inc. We're a full-service mortgage broker and lender. In addition to my other day job as a real estate developer, investor, and entrepreneur, Nate has played a pivotal role in improving acquisitions for all of our investors. I hope you learn a lot, and if there's any questions you have after this episode, please DM us and we can address your current situation and the specifics of that deal. Hope you enjoy the episode. Thank you.
So for most of you that don't know, Nate is my business partner on the lending side. So Nate works with, I don't know, you correct me if I'm wrong, we have access to 80 to 150 different lenders across the U.S. whenever we want.
Right.
We can do basically any kind of loan. The reason we set up a mortgage company in the first place is because I'm a real estate developer. Well, the reason I wanted to be involved in the mortgage space, not the reason that you set up a mortgage company. But, as a real estate developer, access to capital is something that's always very important, and it's always been important for our clients. And instead of referring them out and having it be kind of a crapshoot of who is going to take care of our clients or not, Nate and I teamed up so we could provide the best service and the best lending options to all of our investors and also anyone buying a primary residence, all that good stuff.
Yep.
Hopefully that's a decent summary.
Completely agree.
My allergies are killing me, dude. I came back from Kansas City and I feel like I'm got this stuff stuck in my nose and my throat. It's wild.
The cold up there in Lubbock now?
It's cold today. I don't know what the hell's going on. I like it though. I like when it's a little, between 45 and 65 is good for me. I'm fine. I run hot.
Yeah, fair enough. We got down to 49 yesterday. It was nice to wake up to.
Yeah, so introduce yourself a little bit about, how long you've been doing mortgages, what your background is. Where you come from, fella?
Man, I was born and raised in Corpus Christi, Texas. I grew up in the home building business. My grandfather was a developer. He owned a title company. My dad was a developer with him as well, and his brothers, my uncles. And then my dad got into kind of remodeling when that kind of went south in the early 80s. When interest rates were up 18, 19%, it was pretty insane. And so they got out of that development game and just started doing, custom home building, custom remodeling, things like that, instead of doing a stamped out product and building out neighborhoods. After that, I went into the real estate side, the sales side. I knew that I did not want to work, on the trade side in the building business. I did that every summer for 4 or 5 years, and I knew that I didn't like it at all. Spent about 10 years as a realtor in the Austin, Texas area. Didn't love it. And so, I called my preferred lender and I said, hey, I want to try my hand at this. I think I'd be better at this than I would be, on the real estate side. And that was about 8 years ago. About 5 years ago, we started our own company. But when I first started in the lending business, I went from an assistant to branch manager in about 3 months. And then we started opening branches in West Virginia, Kentucky, Ohio, kind of middle of America over there. We had them in Texas, and it was managing, 30, 35 loans a month, processing them, managing them, traveling, doing all that good stuff. And I got to learn the ins and outs of the business really quickly and really well. From there, I went to the broker side of things where we had ability to do more products that didn't fit inside of, the quote unquote box for most lenders and most retail lenders. Did that for about a year. And then we opened up our own, I opened up my own company, under the name Mortgage Maniac, which is now, registered as Mortgage Inc. And that's what we go by on a daily basis now.
Yeah. Welcome to the family.
Yeah, let's go.
It's the Dear Wealth family. So a couple of things. One, it's hilarious to me that you were a real estate agent. I can't imagine you being a real estate agent at all because there's like zero, bullshit in the way that you communicate or, do things, which is something I appreciate about you. But what I mean, you spent 10 years doing that. What did you like about the mortgage side that drew you over to that?
Well, honestly, I was absolutely terrible realtor. I was probably the worst realtor, bottom 1%. I did enough to where we paid our bills and whatnot, but my heart wasn't in it. There's not a lot to do. It's a hurry up and wait on the realtor side, right? I'm more of a paper pusher. I like the back end work. I like figuring out scenarios to different loan types and making sure we don't say no to any customer, any client, and just getting the job done. This keeps me as busy as I can ever be on the mortgage side. Whereas on the realtor side, if you don't have any deals coming in and you're out there pushing and grinding, then you don't really have anything to do other than network and go meet people, right? But Austin, Texas market saturated. There's anywhere between 15 and 20,000 agents, right? For a town whose metro is 2.2 million now. Back in the days, the population was under 1 million. And so it was extremely saturated, but it was not on the lender side. Yeah. And I think that, having the network I had that I created in the real estate business helped me with the lending business because people knew what my work ethic was. And, I've had clients that come back to me 5-6 times already and either refinance or purchase new homes and kind of rinse and repeat just because we take care of them and we communicate really well.
Yeah. And I think one other thing that's valuable and the reason that, our clients love working with you and what do you think we're going to do volume-wise this year? I mean, we'll probably exceed or get close to $100 million, maybe in loans.
I think, depending on how these last 2.5 months go, we're on pace right now for about 75 million. But I'm not counting anything that's not currently active in our pipeline either. So, depending on, how quickly we run out of properties or how quickly we can develop them, we'll get them all closed by the end of the year. I'd love to hit 100 million. That's year over year. That'd be a 56% increase in business for us.
Yeah. And I think, that sets us apart from a lot of other lending companies, a lot of other, referral partners is that, a lot of these companies are laying people off. Banks are laying people off, downsizing. And one of our unique abilities is to be creative with the type of financing that we can provide to clients. So you had mentioned a little earlier about, the difference between the retail side and the broker side. Can you just explain, in layman's terms, what the restrictions on the retail side are and why it's so valuable to work with a broker?
Yeah. So on the retail side, you have your traditional lenders, let's say Bank of America, Supreme Lending, Fairway, Wells Fargo, those type of lenders, they have their parameters that are set up. And without getting into too much detail, they have what's called overlays in this business. And so the federal government will put out regulations and standards for each loan type, right? Conventional, FHA, VA, et cetera. And then these banks, these retail, operations will go in and with their risk department, with their compliance department, will add overlays on top of those federal guidelines. On the broker side, all of those overlays are removed, right? We don't have any lenders that are going to add extra stipulations to each loan product. For example, a VA loan, a lot of lenders, big banks, Bank of America, is going to, they're going to cap the debt to income ratio at 50%. On the broker world, we don't have a cap. Technically, there is no debt to income ratio that works for the VA loans, right? We just have to make sure that the loan works itself and the residual income is good. If we hit those parameters, then we're good to go, right? I've seen up to 79% debt to income ratio be approved. I'm not saying that's for everybody, but it works if it works. But brokers have the ability to do other loan types as well, right? Like 1099s only or P&L only or bank statement loans, these big retail lenders don't have. And so we have access to, a ton more products as well to put people in.
Yeah, I think, one thing too, being able to help out someone from every socioeconomic class. I mean, from first-time home buyers to, the entire middle class. You mentioned VA, FHA, but also on the high net worth side, a lot of our clients that fit into those parameters have loved working with us just because, if you work with a local bank or like you were saying, B of A, Wells Fargo, these companies, they're not creative at all. They don't think outside of the box on how to get them financed. And if you work with a local community bank, typically they max you out at, somewhere between 10 and $20 million of how much you can borrow. Okay. Well, if you're making $5 million a year and you need to keep acquiring assets or, have lines of credit or financing available to you to continue growing your portfolio, you're going to hit that max really quickly. And so we're able to put together, portfolio loans specifically for high net worth people. Maybe they don't show all of their income on their tax returns, but their cash flow is, $5 million a year, but they're claiming $300,000 on their income. That's very, that's a game a lot of people play, right?
Yeah.
And we're able to find a home for those loans and avoid any lending cap that they might have.
Yeah. Federal government loves self-employed borrowers. That's for sure. If you're going to a traditional bank, right? Because you get to write off less to show more income to be able to purchase that house. We don't have to deal with that on this side.
So a lot of questions that I've been getting, and I'm sure you're getting too, is, well, why are interest rates continuing to go up after the Fed came out and announced that they were lowering the Fed funds rate? And, I can give you my opinion, but I want to hear your opinion and just kind of what's going on in the market.
I mean, the biggest deal with the last, conversation and press conference that Jerome Powell had, the head of the Fed, was that, yes, we're lowering the federal funds rate. It's been high enough for long enough. But he also stated right after that we don't have inflation under control. That being said, those were the golden words, for investors that kind of run the bond market. And much to people's, knowledge base, they think the federal funds rate directly, impacts the mortgage rates, which it doesn't. Federal funds rates for short-term money, HELOCs, auto loans, credit cards, et cetera, things like that. Does it trickle down to mortgages eventually? Yes. It doesn't really move the needle, though. So unless that bond market comes back full strength, we're not going to see a decrease in rates any point soon. They're just going to keep going up just because inflation.
Well, also on the tail end of that, a lot of the, bond holders were selling off leading up into the Fed announcement, right? So if you're holding bonds, you're not going to keep holding higher, keep holding that paper that's a little bit more volatile going into the announcement, right?
Correct. Yeah.
I also think the Fed kind of surprised the market by cutting, 50 basis points versus 25, for instance.
Right.
Then right after that, you have another, you got more global headwinds on things that are also causing inflation. So you have another, conflict in the Middle East. You have the Ukraine-Russia conflict going on. That's all affecting transportation and import-export of goods. So it's taking longer to get the same goods to America at a higher cost.
Correct.
So that's not helping inflation. And then you get some really weird economic data where jobless claims are showing down, retail sales are up, home builder starts are, they're down a little bit, but they're still up from 2019. So it's okay, well, we have this inflationary period, but it doesn't seem to be this big recession indicator. So why cut rates at all?
Right. Yeah, we're just staying on the edge of recession at this point. And we have been for a couple years now.
It's we're just sliding. We're sliding so close to a recession, but not, hitting the technical indicators. we're on thin ice.
And a lot of it has to do with, a lot of it has to do with the data that the federal government gives us, right? In any given month, the jobs report will come out, but 2 weeks later, that gets revised. And this year, I believe the number is like 1.1 million jobs that were kind of oversold to us, right, in the marketplace. So it's a big deal. And interest rates for mortgages are not impacted when the revisions are made. They're impacted when, the first report comes out of the jobs reports. So,
and one thing I look at too, in addition to that, since we're specifically in the real estate market and, as a development company, just looking at competitors, but housing permits are up, housing starts are up. They could be down year over year, but if you're looking at it, time and distance wise, we're not building enough homes to keep up with the current demand.
No.
And so at some point you reach this equilibrium of the interest rates and the amount of people that need a home, period. We just let, a bunch of immigrants into the country, whether you agree with that or not, or, I don't really care what side of the political aisle you're on. That's somewhere between, 8 and 15 million new people that need housing. Mm-hmm. In addition to, birth rates during COVID going up, and, slow down in housing. It's like, we're I think near historical lows on inventory.
Yeah. I think we're near 3 million homes behind on inventory countrywide. It's a big number.
Yeah. It's something close to that. Yeah. Which is a lot of housing.
Yeah, it's a lot of houses.
One thing I wanted to ask you, we going into an election year, and you've been in this business in a long time. How does the market normally react around this every 4 years? What have you seen?
Typically if we have the same, side of the administration remain in office, it's flat, right? We don't see much movement at all. When we get a change in administration, it usually, overnight, the economy kind of gets better. Stock markets take off. The bond markets do what they're supposed to do. So I don't know. It's kind of a coin toss right now. What's going to happen? We'll know in about 3 weeks. But, typically any change in the helm is a positive change when it comes to just the financial strength of the country.
Yeah, I agree with that. And I also think there's just a lot of wait and see right now, going into 3 weeks. One thing I am concerned about though is just before COVID, we had an all-time high in savings accounts in America, like the amount of savings that were in, the average American household's account, and near record lows in credit card debt. All of a sudden, we print trillions of dollars during COVID, some of it, absolutely necessary, a lot of it not necessary. And I think we're still having a problem trying to deploy a lot of that money that has been printed. It's not all out into circulation. If you look at the M1 money supply, right? And overnight, things got more expensive, right? Housing got more expensive. Insurance costs are way up. And all of that savings that was in the American household bank accounts is now gone. We're near historical lows in savings values and at all-time highs in credit card debt. Mm-hmm. So to me, that that's a scary place to be teetering on. What are you seeing from clients? What are you talking people through on how to consolidate that debt? These credit card debts are at 18 to 25% interest rates, but we have all-time highs in valuations of housing too. So how are you helping them consolidate that?
Yeah, we've always kind of taken this approach. Whether it was during COVID, after COVID, before COVID, whatever it is, it's long-term money with a low interest rate is much better than short-term money, i.e. credit cards with 20, 25, 30% interest rates, right? And so during COVID, we saw in some areas a 20% increase in equity in homes and the value of homes. We saw 40%, we saw 60%, depending on what market you're in. And so, with speaking to customers that do have that high credit card debt, let's just say you have 10 grand in credit card debt, you've got, $20,000 car note, you've got, all of these other expenses that you have every month. What we go do is break down their monthly, payments that report to credit, right? So let's just say they have $1,000 that report to credit outside of their, typical mortgage payment. Everything else is $1,000. And if you have 100 grand in equity in your house, maybe we do a cash out refinance for you, pay off all this other debt. We save you $1,000 a month. Yes, maybe your mortgage payment goes up a couple $100, but you're still netting $600-700 in savings per month that you can, put into the market or put into a kid's college savings fund or, whatever the case may be. Buy that new car that you need to buy, and typically, cash is king, right? So money in your bank account is king, as opposed to not having any money and just getting by month to month, paying your bills. And so, we'll take that equity and turn it around. And instead of it, you not being able to access that because it's not easy to access that money, we can turn around and give you that money out. Maybe you put 20 grand in your pocket in the bank and you pay off all your debt, and your net at the end of the day is $700 positive after paying off all your bills. Then, you're in much better shape moving forward. The goal is not to leverage, debt per se with credit cards, right? There's smarter ways to leverage debt, as in buying real estate, that actually increases in value and provides, most of the time a monthly, income on that property.
Yeah. I mean, I would say that's the beautiful, the magic in real estate is the ability to borrow against it.
Well, and the cool thing is that equity is tax-free.
It's absolutely tax-free. And instead of paying that interest rate to your credit card company and paying that principal down, you're not paying yourself back. You're paying the credit card company back.
Right.
So when you make a principal reduction on your home equity line of credit, you're paying yourself back.
Yeah.
You're buying the equity back in your home. It's an asset and hopefully continues to go up, which, you've seen historically.
Sure.
So what kind of different debt consolidation products are there? I mean, I know that there's lots of options, cash out refi, home equity line, are there some streamlined options like, hey, I just want to grab 50 to 70 grand out of my home equity line?
Yeah. I mean,
doing those?
No, I've seen one on the market that'll give you equity based on what you have in your home for future, value of your house, right? So they're going to take a percentage of the equity when you sell the house down the line. There's no repayment terms on it, anything like that. They just want that, basically taking ownership over your property as well, or partial ownership, on title. But, as far as consolidation goes, I mean, really the two main ones are the cash out loan. There's not a streamline for that. And then the home equity line of credit. The home equity line of credit is going to be a lot quicker process than it will be for a cash out loan. But you're still looking at under a month for each one.
Gotcha. What about on investment properties? How can you pull equity out of those?
Yeah, you can do the same thing. And so on investment properties, if you have a single family property, you can take out up to 75% of the value of the house, right? So let's, round numbers. If you have $100,000 house that's paid off, you can take out up to 75 grand. So you're capped at that 25% kind of, you have to leave in the house in equity per federal law. But if it's a multifamily 2 to 4 units, you're going to be capped at 70%. So you can take 70% out. But you can do the same thing, and that money is tax free as well.
Absolutely. And what's the cap on your primary residence?
Primary residence depends on your state, but in Texas, you're at 80% loan to value. Some states go up to 95%. So it really just depends on where you are geographically.
Gotcha. Yeah, it's a beautiful thing, man. I mean, consolidating your debt and $700 a month, back in your pocket's not anything to sneeze at. I mean, that's, buying a lot of groceries, filling up a lot of gas tanks.
Now you're talking about $8,500 a year in your pocket.
Yep.
That's a lot of money.
Absolutely. And it's just going to the bank right now.
Mm-hmm.
Try to get that back out. But yeah, I mean, it's a beautiful thing about the real estate market in general too, is, building real wealth is not selling the assets that you own. It's borrowing against those assets tax-free and acquiring more assets.
Yeah.
Being able to, continue
stack them
up. Yeah, absolutely. So what do you see happening later this year with the, Fed announcements? I think they meet at the end of November, right?
Yeah. Yeah. The plans as per Powell were to drop the Fed rate again. It's going to help credit cards, auto loans. It's going to hurt you with your money market or savings account rates, because those will go down as well. But, we really don't know until that meeting happens. In the mortgage market, we're predicting that, we're going to be even, right? That they're not going to do anything to the Fed rate before the end of the year. That's the way all the experts are seeing it right now. That could change. But we don't really have any indication that they're going to drop that funds rate. Now, there is an indication that we have 7 rate drops built in for the next, 2.5 years. But again, that can change any day. So, it's kind of up in the air. It's just a game at this point.
Yeah. I mean, and also as far as rates go, I mean, everyone's kind of chirping about it, but if you look, like I said, everything's time and distance, right? So if you look back to, October, November of 2023, 30-year mortgage rates were like 8% or higher. Right now you're in the 6 range.
Right.
Right. And if you look at, what was that, March, April of this year, they were in the 7.5 range, and now they're, so the trade-off is that property values from, October, November of 2023 have gone up through the end of 2024, depending on the market that you're in, right? It's always market specific. And you're probably paying $5 to $10 grand more for that same house. And now your interest rates are lower, creating, a more competitive marketplace for buyers. How are you kind of like aligning yourself? What are you hearing from other real estate professionals about what 2025 is going to look like?
Yeah, I mean, all the talk is about inventory at this point, right? With the lack of inventory we have in this country and the high demand, if those rates come down significantly, you're going to see property value increases like we did during COVID. Maybe not to that level, right? 40%, but we're going to see 10%, and we'll see it quick. We're going to see a lot of competition with houses. We're going to see multiple offers. During the COVID timeframe, it wasn't wild to see 25, 40, 70 offers on a house because of inventory. Now, do I think rates are ever going to get that low again? No, they shouldn't have been that low in the first place. I'm glad everybody took advantage of it. But, I think if rates settle somewhere in the low to mid 5s, that's where we need to keep them. It's a healthy market.
Hopefully there's not another global pandemic that requires, the free printing of money.
Yeah. I hope not as well, but in this day and age, it's probably going to happen again in our lifetimes, I would assume.
Yeah. But I mean, one thing, I've been looking at a lot, when you go into an election year, the incumbent president is not seeking a second term, right? So you have you have one guy in Donald Trump that has been a president before, loses his reelection campaign, and he's on the warpath for another seat in office. Kamala Harris is wanting to separate herself from the previous administration. So what I'm seeing in this is that both candidates want to make a splash. And I'm looking at their policy differences of like, what can these splashes mean to real estate. A lot of the other stuff, a lot of the noise, I don't really pay attention to. I like to say, like, if the economy of me is doing well, then that's how I'm voting. That's how I'm planning for my family and my business. But on one side, you have lowering interest rates going into an election. Then you're going to have an election in November, and both candidates have some pretty severe policies that can affect the real estate market. One is you have the bonus depreciation benefit from the Trump administration, which a lot of people don't know about. So in 2022, if you were a real estate professional, you could buy a property and you could accelerate 100% of that depreciation in the first year of owning that property, which is massive. I mean, you buy a, $250,000 house, you can accelerate $50,000 in depreciation and offset that against your income. That's a massive tax advantage strategy to invest in real estate. Well, in 2023, the Biden administration, when they took office, they put in this step down. So it went from 100% to 80% in 2023. This year, it's 60%. Next year, it's supposed to drop to 40%. And then I believe it goes to zero. Well, if Trump gets elected, he's in his policy is saying bringing back 100% bonus depreciation. Well, not only that is that good for individual investors, which is going to create a massive wave of buying power for individuals and funds, but it allows you to, I believe it allows you to take that retroactively into your 2024 tax year.
Right.
So you're talking about bringing in a massive amount of money and capital into a market at, low interest rates in comparison to the last 2.5 years. On the other side, you have the Harris administration that is offering, they want to give, $25,000 subsidies to first-time home buyers, what's the subsidy now?
Is there
None,
one?
Right?
I don't think there's not a national subsidy, no.
Right. So, you already have, FHA assistance, which is, what is that? It's 2.5%.
Oh, you can get anywhere from 2 to 5%.
Yeah. Okay. So, $25,000 on that money, that's you're buying a $400,000 or $500,000 house.
Right.
Right. Roughly.
Yeah.
My math is correct. So you're creating a lot more buyers coming into a market on the Harris administration. And anytime the government subsidizes a market, it makes it go up. It makes it become more expensive. In addition to that, she's talking about a national mandate for rent subsidies. So making rent more affordable. Well, if I'm a landlord and I'm charging, $11.50 a month for rent, and the government comes in across the board and says, hey, we're going to subsidize affordable rents for everybody up to $1,500. Well, now there's just more money. You saw this with like college tuition, right? Once the federal government got involved, the average cost of college went from like $8,000, $12,000 a year to now it's $40,000 a year to go to college. It's crazy,
yeah.
Right? So rents are going to skyrocket, paid for by tax dollars. So either way, having your money positioned in real estate as an asset, you can't go wrong almost. Agreed. It's like Kamala Harris gets elected, I'll make more money than I've ever made in my entire life. Trump gets elected, I'll pay the least amount of taxes I've ever made in my entire life, and I'm going to use those tax dollars that I would have paid the U.S. government to own real estate.
Right.
So it's like
they're helping you buy more assets. Right. The big thing with the Harris, proposal for that $25,000 subsidy, to whoever they're going to give it to is it's going to create more competition in the marketplace. It's going to drive prices up. Right. Absolutely. I mean, it's basic economics. You have more people wanting to buy and we're already at a deficit with inventory. It's going to make things harder for people. The whole goal, I think, of their proposal is to make things easier for people to buy a house. It's going to do the complete opposite.
Yeah. Well, in the short term, right? more people are going to be able to buy homes. But in the long term, you're pricing people out. If you look at, average wage growth, that hasn't anywhere close caught up to the increases in owning a home. And I'm not even talking about just like buying the house, like the insurance cost of owning a home, the, taxes all go up when the property values go up. I mean,
insurance year over year, property insurance year over year is up 46%, 44%. It's crazy. It's getting very expensive.
Explain that to me. What is going on? I mean, I know we've had some, natural disasters that always trickles its way, nationally, actually, because you have these national companies that are trying to spread their loss coverage over, all 50 states. But did a law change? Like, I don't remember what happened, but something happened where insurance just like all of a sudden skyrocketed.
Well, the insurance companies who insure the insurance companies are the ones that are running the deal. And that's what we don't see. And so I don't know the bottom line of why and how, but I do know that that's the case, right? And the federal government, they'll, resell these policies back to the insurance provider that provides insurance for the insurance provider. And that cost has gone up, right? And so, as the federal government subsidizing, the income, nationally through that, I think that's, one of the cases. It's an income stream for them.
Yeah, that makes sense. I mean, I think the other side of that too is you have claims probably at all-time highs. I'm just guessing. I don't have stats to back this up. But when you create economic uncertainty and, fears of recession, I can speak to this like in Lubbock. Anytime there's, wind or hail that hits the town, everybody calls a roofing company and makes a claim against their roof.
Yeah, because whether or not you get a new roof.
Yeah. Well, and they, they'll work something out with the roofing company where, I'll pay you $2,500 to replace my roof and we'll split the difference. They're like, whatever. I mean, there's a lot of fraud that goes on.
Right.
Then you have something like, Florida that just happened with these hurricanes that rolled through there and, the Appalachians, North Carolina, all that. But, people are leaving Florida. I'm interested to see what happens with the real estate market down there, because when you look at the cost of acquisition, I mean, it is insanely high. Mm-hmm. So, 4 years ago, 5 years ago, you could buy a house, in a nice, in Tampa Bay, Florida, right? Let's say for $750,000, that house is $1.5 million right now. Mm-hmm. Insurance costs have gone up 50% or more. And when they come back out with insuring that property again, after the recovery, I just don't know how you justify spending $1.5 million in a market plus paying for the increased insurance costs.
Yeah, no, I completely agree. And, from what I hear on the ground in Florida, it's a very heavy cash market. So they have a lot of cash buyers that come in, and a lot of people are self-insuring now and not going through insurance companies because it's so hard to even get a policy on a house, right? These insurance companies don't want to insure Florida, that peninsula, at all.
Exactly. But that's, the 1% of 1% that's buying properties in Florida in cash, right? So how do you have a long-term sustainable economy when you can't afford to live there as a middle-class citizen?
Right.
You can't even pay the insurance costs.
I agree. Yeah. They've got to build some affordable housing, and, starts at the state level. So
yeah,
hopefully you get it figured out.
Yeah. What markets are you seeing a lot of activity in right now where people are buying or borrowing money for purchasing?
Houston's a huge market, not only for primary homes, but for investment as well. On the investor side, there's just a lot to do in Houston. It's a good market for food and culture and, sports. They have every sporting, professional sporting event that you can imagine. It's close enough to Dallas and Austin to where you can get to those cities pretty quickly within a couple hours, San Antonio. But I'm seeing a lot of money being spent in Houston right now, and it's also affordable. Again, we run into the issue there too with insurance, though, right? The closer it is to the coast, on the east side of Houston, the harder it is to insure. But if you're on, the western part of Houston and Cypress or in Katy, then it gets a little bit easier, right? So you don't have to deal with the flooding, and the hurricanes usually don't push that far in when they hit the Houston area. So even going out towards Galveston, they're having the same issues on that island as they're having in Florida, right? These houses that are being built, are $1 million houses, and the policy premium is $15,000 a year. It's insane.
That is crazy.
But Austin's always a good market, and it always has been, always will be. San Antonio's experienced some just huge growth right now. It's probably the most affordable big city in Texas, outside of like El Paso, if you want to live up in that armpit of Texas. But,
well, they're benefiting a lot too from Austin becoming so expensive. So you're getting a lot of, tertiary buyers moving to San Antonio. I like that market a lot. I love Houston. I mean, as you know, we're building some stuff in Houston right now. We have a lot of investors buying stuff there. I'm building some stuff for us to hold as well. And, a lot of what I look at too that I really like is like industries that I think are going to do really well over the next 5 to 10 years. And you look at Houston, you have oil and gas, you have medical, you have med tech. I just don't see how you can go wrong when all of those sectors are like leading the S&P 500 and investing more money into growth and expansion, hiring employees. You're seeing that population increase. I mean, number one, you benefit from being in Texas, right? You can kind of throw a dart anywhere in Texas and see population going up. But then when you start drilling down on those like submarkets in Texas, okay, you got Houston, Austin, San Antonio, Dallas, Fort Worth, Lubbock, Amarillo, Abilene, right? Which ones are going to do the best over the next 5 to 10 years? And I would put Houston number one over all 4 major cities in Texas.
I think so too. I think a lot of people are moving out of Austin at this point that have come there and temporarily stayed for a couple of years just because the housing market, the prices are extremely high. Our property taxes in Texas are a little higher across the board than anywhere else, but we don't have a state income tax, and we do have a sales tax, but that's something you can control. It's the sales tax, right? You don't want to pay it, don't go buy anything. It's an easy control.
Well, unlike most states, though, too, Texas puts its tax dollars, its property tax dollars. Like I would rather spend my money on property tax any day of the week, as long as the government is putting that money to use and improving the municipality, improving roads, improving schools, drawing businesses here, making investment. And Texas has done a phenomenal job of doing that. When you compare that to, somewhere like Illinois, you compare that somewhere like, the Northeast, it's just, it's unparalleled.
Yeah. I mean, the growth here is unparalleled as well. So, we're having a lot of people move down from the north that are tired of the snow, and, Californians moving in because they're tired of, paying, $2 million for a 600 square foot house. There's people from New York coming down are experiencing the same thing, and maybe they want a little bit more space. But, Texas we can offer everything, right? If you want rural living and want to live on a ranch, we've got it. If you want to live in a big city, we've got that too. If you like your sports, they're all over the place. So there's a lot of attraction to this state.
Well, you mentioned Austin too. Like Austin, so, I've done some development stuff in Austin. You made some investments there. Austin's biggest problem, in my opinion, is how small it is. Mm-hmm. There's not, so if I compare it to Houston, you have all the surrounding MSA of Houston. It's massive.
Yeah.
You can get, farmland. You can still be downtown in, 30, 45 minutes. Austin doesn't have that. Mm-hmm. So you've got like the Austin proper, and then you've got, Round Rock, Texas, and a couple other like little like tiny little areas, but there's not a lot of available property around there. And it's not, and if there is, it's extremely expensive. That's why I think San Antonio is benefiting from that, right? You got more room to spread out around San Antonio than you do in Austin.
Well, yeah, in San Antonio, infrastructure-wise, they planned for it to grow, right? You know, you have that loop, the outside loop, 1604, which was, man, when I was growing up, that was out in the middle of nowhere, and nobody knew why they built it, right? But now it's in the middle of the city. So, you know, they just planned it better. Austin, I don't think they expected the growth, you know, that they've experienced. In the late 90s, early 2000s, it was under 1 million people. And you jump 20 years later and you've increased to, you know, over 2 million. It's a pretty big jump in population growth. For a small area, right? With no traffic, you can get north to south in Austin in 15 minutes. But there's never a time when there's no traffic.
Did I know a couple of years ago in San Antonio and Austin, they were talking about putting in like a high-speed rail. Is that still happening?
Hadn't gone anywhere as far as I know. You know, San Antonio is still building along the 35 corridor. They're building a flyover that has 2 exits to get from north to south and south to north instead of sitting, you know, through traffic in downtown on 35. I think when that's done, that's going to help alleviate a lot of congestion and make it a lot smoother to run through there. You know, Austin, I haven't been in a while, but I think they're probably trying to do the same thing. But, you know, mass transportation is something that this state needs and we just don't really have, right? So whether it's a monorail or a subway or whatever the case may be that connects these cities, I think it'd be extremely helpful.
Well, the last thing I saw, I know there was plans for it a few years ago. It kind of, you know, lost steam over COVID, right? Because, you know, we have bigger fish to fry. But then they kind of brought it back. A bunch of politicians and city council members and stuff signed a letter advocating for continuing the conversation to get that going, because the I-35 is a nightmare. I mean, between San Antonio and Austin. I
mean, from Laredo to Canada, it's a nightmare.
Yeah, that's true. But, you know, they get a high-speed rail in. Let's say they connect it to, you know, Dallas and Houston and San Antonio. Like, that would be huge. I think, you know, Texas would massively benefit from that. I think real estate would massively benefit from that. I
mean, I'd love to jump on a high-speed rail from, you know, where I'm at in between San Antonio and Austin to Dallas to go up there for a weekend and not have to sit for 7 hours on I-35, you know? Yeah. It'd be great.
Think about how many like murder mysteries you could solve on one ride.
You're watching too much Netflix, buddy.
I don't know, you know, whenever I'd like travel through Europe and stuff like that, whenever I was on a train, you just kind of get that, like, you know, I don't know. It's just weird. Everyone's like sipping tea. It's like part of the culture.
Right.
You can order dinner. The train cars are really nice. You know, get a cocktail. Just be nice to have that.
Yeah, it would. I agree.
Well, I appreciate it, man. We're going to have to do this again. We should do this like once a month at least.
Yeah, let's do it.
Everybody. Cool, man. Well, I appreciate you taking the time.